Interactive Brokers webinars. It's my pleasure to welcome to our webinar program Ryan Gorman from the CME and Jim Urio from TGM Institutional Services. Hey guys, how are you?
Thank you for having me, Jeff.
Doing really great. Thanks, Jeff.
My pleasure, and thank you guys for coming by. Really appreciate all the educational contributions both of you do. I guess in collaboration with us. I'm going to just kind of go down to the disclosure. So for the audience, a couple housekeeping items. Just please take a second or a couple minutes to read over the disclosure. Also, you'll find a copy of the handout that Jim and Ryan are going to go over. It's under handouts. You can download that. It's a good resource. You can download it, save it to your computer, look at it later. If you have questions, please type them in the questions box. We'll get to them at the end of the webinar. And then also a lot of times we get asked if this is recorded. It is. If you've registered for the webinar, you'll receive a email toward the end of the day with a link to this webinar that you can go on. Even if you've made it in, or maybe something came up and you weren't able to make it live, you'll still get that link. And like all our webinars, even if you didn't register, you can go to interactivebrokers.com site, go to education, and you can look for previously aired webinars and always find great past webinars from CME Group and TGM Institutional Services. And on that note, I'm going to turn it over to Jim and Ryan. Thanks, guys.
Thank you, Jeff.
Thank you. Yeah, I appreciate that, Jim. But yeah, we're to get started. I'm super excited. I know Jim is excited to kind of keep this going here. So just kind of a refresher. This is a 5-part series. This is part 2. But as we kind of introed things 2 weeks ago, it was basically, hey, what are futures? What's going on with the futures market? How do they relate to, just your basic stock trading, and how it can be important and fit into your, trading strategy, into your investing for your life. And we wanted to build this out in, a progression of, hey, intro to futures all the way at the end to how do I actually go and apply these strategies and these methods? So what we're going to talk about today is, now that everybody that was here last week, understands what futures are, what their role is, now we're going to get into how do you start analyzing these things? And what that breaks down into, again, it's fundamental and technical analysis. So what we're going to do today is, we're going to start off with just a quick recap, some benefits of futures trading, what futures are, and then we're going to dive into a lot of different fundamental factors for a ton of different markets, kind of across the CME suite, in different asset classes. We'll dive into a lot of different technicals, a lot of chart patterns. We'll go into some specific examples. Jim, you're going to be here with me the whole way, giving your really great perspective over your years of trading, what some of the technical systems are that you use, how you use fundamentals, and, the way that you can look at both of them to kind of go through a trading strategy.
Sounds great. Looking forward to it. I like to talk about this stuff, Ryan.
Yeah, absolutely. And thanks again for joining. I'm super excited. But yeah, as we kind of get into it here, so the first slide here is just talking about what are futures again. Just a quick recap for anybody that might not have been there, or just to keep things rolling. So futures again, futures are different than equities. Futures are a standardized contract to buy or sell at a specific date at a predetermined price in a future date. So basically what that breaks down into from equities is, I think people understand equities. You're buying a part of a company, you're buying a share. Futures contracts are different. They are not assets. And there's a lot of things that go into that in terms of key characteristics. Leverage being one, being able to control a large notional value with a smaller amount of capital. Standardization, these contracts have set sizes, quantities, and delivery dates. And then centralized trading on an exchange, CME, ICE, etc. And then again, why trade them? The main 2 reasons right off the board are hedging and speculating. So your hedging is going to be your farmers, your ranchers, your airliners, looking to lock in prices for future purchases or sale of the underlying asset that they produce or are looking to purchase. And then there's speculation, which is, hey, I think gold's going to go higher. I think the S&P is going to go lower. I think NASDAQ's going to go higher. Going in and being able to establish a view in the market and take a speculative play on these different markets. As we kind of go through the benefits here, Jim, I'm sure you can talk about this forever, but looking at some of the benefits, I mean, Jim, just off the bat, what kind of stands out to you if you were going out to a stock trader and saying they're asking you, why would I even look at futures? Where does your mind go?
So the single most important thing that you mentioned is capital efficiency. For instance, and correct me if I'm wrong, but if I'm wrong, it's not by much, is that to trade an equity index, it's about 1/20th the margin you have to put up. So it's 20-to-1 margin that you get there, which, by the way, is a good thing if you know what you're doing. It's a terrible thing if you don't know what you're doing, because it can open you up to losses. I want to just always stress this to people. This is an extremely powerful tool. I always equate it to the power tool in the garage, that if you know how to use it effectively, the garage gets built way quicker. But if you don't know how to use it right, somebody's going to lose a thumb. That's the way leverage is in these markets. It's important. You mentioned on the slide, it says the ease of going short. Remember, in equities, to buy something is easy in a straightforward transaction. To sell something short, you need to borrow it, and within your brokerage house, they need to have it available to borrow. When you go to futures, because it has a distant delivery date, the buying and selling are exactly the same, and it's completely frictionless to go short it. The third thing that we didn't mention is 23 hours a day of extremely liquid markets in most of the CME products that I trade, which is a tremendous thing, because it used to be, like even for agriculture, that it was mostly a domestic thing because we grew a ton of corn here, we traded a ton of corn here, but now it's global. So global headlines can hit at any time at night, and global headlines can affect the oil markets, the ag markets, the gold markets, and to not have access to them, I don't know, was a source of frustration for me trading stocks, and with futures, it's not there. So I think those are the three most important things.
Yeah, I like what you said there. I mean, it hints at, some of the three biggest things that we always talk about: being able to use more with less capital, that capital utilization aspect of it, having just general access to markets outside of, in Chicago here, you're 8:30 to 3, and there's a lot of things that go into it, but I think you kind of nailed it. But, direct access to markets, being able to actually trade the price of gold, being able to actually trade the price of oil. If you're a technical trader, which we'll get into a lot of different technicals, if you're understanding technicals on the equity side, you can translate almost all of that exactly right over to futures and be able to use that technical analysis to your advantage. So I just wanted to get that kind of going, just to get a fresh reminder to everybody, exactly why we're doing this. And, I think it's important to always highlight some of the benefits. At the very least, coming out of this, you'll have that understanding again of why you should maybe even consider them. But we're going to get into the fundamentals to kind of start things off. As we think about fundamentals here on the next slide, there's a lot that goes into it. So thinking about the fundamentals, the macroeconomic drivers. So what we have first, monetary policy. So that's, interest rate, inflation, quantitative easing, heavily influencing currency and bond futures. An example, a hawkish Fed strengthens the dollar and can drive down treasury futures. But there's a ton of economic indicators that you can think of on like the general side of things that can affect a ton of different markets across the board, from equities to precious metals to currencies, and then even more specific down to like oil and agriculture. But thinking about like GDP reports, signal overall economic health and potential demand. Employment data, inflation reports, all these things, right now it's a little bit weird of a time because we're not getting all this information with the government shutdown. But in a normal world, under normal conditions, these reports come out very often, and it's something that if you're trading a lot of these big macro, products, you kind of have to know at least what these mean. If you're looking at your chart and you just see it fly down and you hear about it was because of a GDP report, or you just hear, oh, I heard on the news it was because an inflation report came out. It's something that is important to understand before you put on a trade, before you are looking at a market, because, you want to be able to act, before some of these things happen. You don't want to be in a reactive space. And as we kind of think about it a little bit more, these things really drive the markets. A lot of the times you'll get these big numbers, whether it's, even if it's right in line with expectations, that can move the markets as well. So it's kind of the intro point if you're thinking about the fundamentals of, the overall market, the overall economy in the country here and globally. A lot of these reports are kind of right where you start, like these big ones, like you have CPI, you have GDP, you have employment, you have inflation, things like that, we aren't getting them right now, of course, but as we do get a lot of these reports, it's going to have an effect on your overall trading and your strategy.
Can I add something to that, Ryan, real quick? Because I love that too. And I use at unfilteredinvestor.com, we always say that we are 65% to 70% technical analysis and the other 30 to 35 fundamental analysis. The problem with fundamental analysis on the short term is that you have to get information quicker than everybody else does, which obviously is very, very difficult considering it's a whole global trading this thing too. And you have to be able to ascertain what market position is. For instance, if you think that a good GDP number is then going to boost stock prices up, right? So there's something we always say in trading is that oftentimes you buy the rumor, sell the fact. There is a chance that people load it up with that expectation and you see the good GDP number, and instead of people rushing in to buy it, there's the people who already bought it who are rushing to sell it. So it's oftentimes it acts the opposite way of what the fundamentals will dictate, and that's on the short end. Longer term, I actually think trading from fundamentals for a medium to investment portfolio, I think is sound. If you're in the AI space and you understand what companies are good, saying this company is going to kill. But I will mention this, is that with fundamental analysis goes, Eugene Fama won a Nobel Prize for his thesis that at any one given moment in time, a heavily traded market has digested every piece of information that's available. So if you think you have an edge and you're seeing things a little bit differently in the medium and long term, which I say more power to you, I'm not saying that you might not, but it is important to know that you are competing a lot of people who are digesting that same information. Technicals, on the other hand, technicals talk about sentiment and momentum and direction. And for me, that's a more clearer sort of roadmap to how to trade in the short and medium term than fundamental analysis, although I'm very, very into fundamentals as well.
Yeah, and I really like how you said that. It's something that it's kind of the whole thesis of this presentation is, you can have great fundamentals. You can be a great fundamental, analyst. You can have your great technical precision, but the reality is, that we find is it's that blend of both, whatever that blend is for you. You mentioned your specific blend. Some people might be, 80% technical and, 20% fundamental. Some people might be the inverse of that. It's something that you just kind of have to work at, and you have to figure out what markets are going to help you on the fundamental side, what you're better at on the technical side, and go from there. So that really kind of will bring it all together. But thinking again, as we kind of think more about fundamentals, a lot of it comes down to shifts in demand and shift in supply. So the entire demand curve can shift right or increase, or it can shift to the left, which is decreasing due to factors other than price. So other than just the technical side. So an example would be if a product becomes, very trendy, very popular, the demand for it will increase at every price point, shifting the curve to the right and leading to a new higher equilibrium price and quantity. As we think about supply, so as supply can shift, the entire supply curve can shift to the right, which increases, or to the left as a decrease. An example of that is a new tech, some new, if it's an AI technology, makes production cheaper. Producers will be able to supply more of the product at every single price point, shifting that curve to the right. So a lot of the times, if you think back to macroeconomics back in the college days, or microeconomics, mostly macro, writing down, if you're ever confused about shifts in supply and demand, pen to paper is a great place to go if you really need to. It can never hurt. Say, hey, what is this price? What is this effect going to have on supply and demand? Because that is kind of the fundamental starting point of a lot of fundamental analysis is, maybe if it's an earnings report you're looking at, is that going to shift the demand for people wanting to buy this company or not? And being able to break down where that goes. Is a company not producing as much as they thought they might have? Is the shifts in supply going to, break down and affect that overall price? So I always reiterate that to people. Don't forget your basic supply and demand. If we really can break things down, that's where you're going to end up. And that's kind of a lot of the times the final bullet point you hear if someone's pitching you a stock or a futures contract. The kind of final point is usually there's going to be less of it, or a lot of people are going to want it, or nobody's going to want it. And that is kind of the core of all this fundamental supply and demand.
I'd love to build on that supply and demand thing just by talking about two specific commodities. One, gold. In September of this year, now it was already brewing that the central bank buying gold trade of the last 3 years was working well, and it was already starting to filter down to a more retail level. So then in September, Morgan Stanley comes out and says, yeah, you know how we've been saying 60-40 for forever as far as portfolio construction? We're changing that to 60-20-20 stocks, bonds, and drum roll, gold was the 20%. So all of a sudden in September, it's like acknowledges it to the retail. So supply didn't change of gold, obviously, but demand all of a sudden did quite a bit. So from September to October 20th, gold runs up another 30% as this next wave of buyers comes in. Now, the unfortunate part is when not that unfortunate, but when the retail traders come in and start grabbing it like it's almost a meme stock, which I know I'm being hyperbolic, that creates a lot of volatility. And now since then, we've seen a 10% pullback. So now that's an issue of demand in gold. Now, oil, the shocks exist to the supply side, not the demand side. Like if a crisis happens and people are rushing to buy gold, that's the demand that's being shot up. Now in crude oil, the shocks are to the supply side, like a headline out of the Middle East, something that is going to greatly reduce supply, then all of a sudden crude goes through the roof. So it's two different commodities that tend to trade on two opposite sides of that supply demand equation. I find it very interesting. I hope the people do as well.
Absolutely. Yeah, it's important to really, understand that and the dynamics that each market is different and the way they react to the fundamental side of things is very, very different. So I appreciate that insight.
Right. Both of those, the disaster exists to the upside. That's why calls will be priced higher, but they get that way from two separate angles.
Yes, 100%, 100%. And, as we, a little bit more on the fundamentals here on the next slide, as we kind of think about it a little bit more, just from that, the supply and demand dynamics. So think about if you're thinking about commodity markets, the fundamental equation is simple, is high supply or low demand leads to lower prices. Low supply and high demand can lead to higher prices. And there's a lot of key supply factors. So production reports, this you'll see for agriculture with the USDA or some of these WASDE reports. Energy, you have EIA data. Thinking about these production forecasts are super, super important. How much of the end product is expected, how much is delivered. Weather patterns, thinking directly about, if we have a hot and dry summer, in South America, that's going to have a huge effect on the, bean prices here in the US or across the world. If it's going to be super rainy, we're going to get, super wet, time of the year, that's going to affect prices a lot. OPEC plus decisions, that directly is, affecting crude oil supply. And we're seeing a lot of that, over the last couple of years. We've had a lot of ups and downs with the supply coming out of the OPEC. And then thinking about that from the key demand factors, thinking of industrial production, drives demand for metals and energy, and consumer confidence affects demand for consumer goods and raw materials. Jim, I wanted to kind of pitch this to you, thinking about, some of the bigger reports that might come out, if you're thinking about some of the markets you trade, what are some of the ones that you are typically watching, on a weekly or monthly basis that will kind of help establish your fundamental bias?
So it always, for most of my career, was the employment picture. So the first Friday of every month, the BLS data. Now it's shifted to the CPI data, which, by the way, and I just wrote an article on this about CPI, what is a completely flawed data point. PCE is slightly better, but CPI comes earlier in the month, and the market is used to trading on CPI as an inflation indicator along with its flaws. So if the market's still trading on it, then it has the power to move markets, obviously. But those are the things that's important. Right now, we expect the Fed to keep easing. We expect the Fed to ease today, which is the 29th, and then we expect them to ease again in December. What could change that? Well, if all of a sudden that CPI number that we saw last week, instead of coming out of 3.0, which I thought was high, and we acted like it was low, but I guess that was just me on an island. But if that thing came out at 3.3, showing CPI was accelerating, that could have so dramatically upended the fundamental picture as it relates to the Federal Reserve and interest rate picture. And I will tell this to people who are watching is that, and this comes from a guy who's been more involved in the rate markets than anything else over the last 40 years, but I do think that rates affect every other asset class more so than any other asset class affects other assets. So I personally think that rates are something that everybody should be watching because, the cost of money filters into the price of anything else. And those two data points that are, the most watched, which is the NFP numbers and the CPI data, obviously affect the Fed. Even if they're corrupted data, the Fed still watches them and could move on them.
That's a great point you brought up too. Thinking about fundamentals, these economic reports, they're all important, but other market movements also. If you're trading gold or you're trading the S&P, if there's a big move in rates, that's going to affect those markets. And it's something that you kind of have to consider, more than consider. You kind of have to be very aware of, what would a 1% move in rates to the upside or downside do to my position in gold?
Right. And historically, let's walk people through the chain, because let's say the CPI number comes out high. All of a sudden, we were pricing in easier money. We can't price in easier money anymore. So rates have to go a little higher to compensate for inflation. So rates are higher. Gold doesn't like higher rates because remember, the holding gold gets you zero rates. So the higher interest rates are, the less attractive gold is as a position. Now, I fully understand that is a rudimentary description of it, particularly in a global world where global central banks are buying gold at a rate not seen in 80 years. So I'm just boiling it down to the thumbnail. But that it should affect your gold position negatively if rates go higher. So it's an interesting little chain of events, in my opinion.
No doubt about it. No doubt about it. So as we kind of progress through here, the next slide, geopolitics. This is a big one right now. And, we sort of touched on it, but there's a lot of things out there that when you're thinking about fundamentals, these are kind of the things that are tough to price into your trade. If you're thinking about political instability, conflicts, elections, policy changes, right now we have trade wars and tariffs going on globally. Seems like every day we see a new, headline that sends the market, S&P, NASDAQ up or down 1%. Just based on, easing or cooling tensions, things like natural disasters, a lot of things like this that come out. It's important to understand what the effect can be. And this kind of goes into sort of your pre-trade analysis is kind of how I always say, because if you're trading off of events like this, it's very reactive. You can't predict a natural disaster. You can't necessarily predict that a conversation about trade talks and tariffs is going to go well or it's going to go poorly. So when you're going into a trade, understanding that these can be big volatile events that can affect your overall positions. And it's not something that you want to, read at 2 o'clock after you got in a position in the morning and just be like, oh man, well, that happened. More tensions we're seeing, with another country, or, we have these new tariffs coming in and my position is completely wiped out. So it builds into your overall strategy on, maybe where your stop is, or, how tight you're managing your risk, especially in times like this where, at the drop of a hat, one headline or one little, blip from a news conference can send the market up or down. And, right now it's definitely, we're in an environment where that is very present.
So I'd like to, because what you said was bringing up some fascinating tales in my head about how it really affects. So let's talk about the trade wars, as you said. Okay, so we go into this trade wars, and everyone knew 2025 was going to be somewhat of a tumultuous year with the Trump administration trying to rework trade around the globe. So what are the ramifications for the stock market? Well, you could, if you tease away the Fed and liquidity, you'd say, well, global trade doing poorly, that should negatively affect our stock market. But should it? No. I'll argue that the opaqueness, the confusion of global trade affects the Federal Reserve to slant more dovish than they otherwise would, not knowing full well whether or not that dovish stand is appropriate or not. So I believe that's what's happening now, because we're seeing how these things are falling out in a completely chaotic system that we don't know where it's going to end up, but the Fed thinks it has to be dovish. So what's happening to equity markets? They're going through the roof. Now, I fully understand that the AI trade and enthusiasm for AI is a huge driver of that as well, but I don't think you can ignore that Fed liquidity, particularly Fed liquidity being injected in the system in the tune of lower rates and stopping quantitative tightening, which they talked about last week, is they're doing so without really a clear picture, whether it be the government shutdown, they're not getting data, or the fact that trade policy around the globe is difficult to figure out where it's going to lead to. It could all of a sudden end up with a picture of Xi and Trump holding hands saying everything is fixed next week. And if that happens, then what happens to the stock market? It should be okay, but there is a chance that that'll mean the Fed won't be easing rates. I don't think this will happen though, by the way. And then all of a sudden the stock market could suffer in another buy the rumor, sell the fact sort of scenario. I hope all that makes sense. I know I get a little excited about this stuff, but I think it's so much fun.
No, yeah, I mean it's fantastic. Bringing it to real life, can really, adds a punch to it. We could talk about what these things might mean, but being able to actually say what happened, what's actually happening, maybe get some different views on it.
Oh, can I add one other thing too, Ryan?
Yeah.
Because remember, part of the thesis on gold since 2017 is global central banks have been buying more. When the U.S. froze Russia out of the SWIFT payment system back in 2022, I'm not saying whether that's right or wrong. I'm just saying the policy ramifications around the globe where people started getting out of dollar and treasuries and more into gold. I have statistics on that if anyone wanted them, but I don't want to go too deep in the woods. Now, let's say all of a sudden next week, China and U.S. shake hands, and China then agrees to start buying U.S. treasuries. Well, that'll lessen the demand for gold, and that could be one of the reasons we're seeing gold up and down like this, trying to digest that possibility, not probability, that possibility.
Yeah, 100%, 100%. And thinking about just everything we just talked about, that's the one side. You call 50% if you want. That is the fundamental factors. What the whole thesis of this presentation, as I mentioned, is let's bring the two together. So going into the next part of this is going to be the technical side. So the technical side, there's a lot that goes into technicals. There is, 1,000 different things. If you talk to a technician, they're going to tell you, a true technician will tell you, hide the symbol. I don't care if it's futures, if it's equities, I will tell you the direction of the market. I will be able to tell you fundamentally looking at the charts, the support levels, the resistance levels, where a lot of action's happening. So we're building sort of a bridge, the bridge from fundamentals to technicals. There's a lot of different ways to think about it. Fundamentals tell you the why, is kind of how I think about this. They explain the underlying forces as all the things we've talked about, trade tensions, tariffs, government shutdown, all these different things, economic reports. Technicals, they help with the when. They help, you time your entry and exit points by analyzing price action. So you can have the best thesis in the world about, a fundamental analysis for crude oil, let's say. You think crude oil is gonna, go up over the next 3 months, for example. You gotta then go, okay, now what? Do I just buy it? Do I look for prices to come down a little bit before I buy it? Do I buy it on strength? There's a whole nother side to it of the actual application, and that's the technical side. And Jim, you talked about this right away at the beginning, and I'm glad you did, because it hammers home the point of the approach that we would look for would be the combination of both. Using your fundamentals to identify a strong direction, to identify a trend that you believe is there and is going to continue to remain in that way, or if it's going to flip, and then using your technical analysis, your TA, to pinpoint the ideal moments to get into the trade, to get out of the trade, where to have your risk management set on both sides.
Yeah, and even hedge funds that are fundamental hedge funds establish entry points based on technicals. Like I'm not sure if all of them do, but everyone who runs money that I've ever talked to in my 40-year career, they claim to be a fundamental hedge fund, and they are. And they're like, oh no, but yeah, we definitely use technical analysis of when to get in. We're not going to buy something that's so much above its 200-day moving average, 50-day moving average, meaning that everybody's rushed in to buy it already. We're going to try to get control and get a better price. So I love what you said about, and not to turn this into a patting on the back, the whole thing, but I'm going to pat you on the back anyway. The why, you can talk about the fundamentals of why things are moving, but that doesn't make you any money. The when things are going to move and in what direction they're going to move, those are the things that can provide for effective risk hedges and speculative trades.
Yeah, 100%. I couldn't agree more. So there's a lot of things that go into technicals. The first thing we're going to get into is some chart patterns. Now, take this with a grain of salt. There's a million chart patterns. And one thing I will say, once you learn about a chart pattern, even if it's not presenting itself on a chart, you might start seeing it or wanting to see it just a little bit more because you understand what it is. And these chart patterns, they don't always pan out perfectly, but there's a reason that they're established. You will see, if you can see some of these, being able to identify them can help you just overall with your strategy. But thinking about just some different chart patterns, and we'll get into some more of them outside of this, but we have like reversal patterns and continuation patterns. So thinking about reversal patterns, it's a signal for a potential change in a direction of a trend. So a thing like a head and shoulders, so often forms at the top of a market. You can also have an inverse head and shoulders, which you could see at the bottom of the market. Double tops and double bottoms. That's when, speaks for itself. You'll see a market hit the same level to the upside twice and get rejected, or to the downside twice and get rejected. Basically, repeated represents a failed attempt to push prices higher or lower. And then if we think about continuation patterns, a signal that the current trend is likely to continue to go up or down. So there's triangles, there's a bunch of them. Symmetrical, ascending, descending triangles can indicate a period of consolidation before, an eventual breakout or a break lower. And then there's things called flags and pennants as well, which can be short-term patterns during a strong trend. Now, as we kind of go into it, the next slide, Jim, I think you'll be able to kind of point out, looking at some of these, do you take a bunch of stock in these types of technical patterns? Are there any specifically that you would look for, or anything that you find value in looking for patterns like this?
I think every one of these patterns has some level of validity to it. So I think some are important. There are some that I think are more important than other that I've had good luck with over the years. Like look at the flag pattern. That's the second from the bottom on the right. Okay, yeah. I like a sideways consolidation pattern is quite nice. I like a flag that actually starts to shoot up, then it starts to consolidate on a slightly lower trajectory, and then breaks out to the upside as the one in the flag pattern that you see. So I think something like that is a very, very valuable pattern. But every one of these I've looked at, and it goes on the side of the ledger of things to be cognizant of. But now we've talked a lot about what we use at unfilteredinvestor.com, and we look at all these things, and these are all important, but they're not the top of our list. The top of our list is the 8 and the 21 exponential moving averages, and when they cross and when they begin to widen, and if an asset can come down into the middle of those and then starts to come back out, that gives, and we'll talk about that. I know you have that on one slide going up, and then different, harmonic levels every 12.5% of where then markets tend to go to. That's how we pick our objectives. But for entry points, we use those 2 moving averages and the 50-day simple moving average as well. It used to be the 200-day simple moving average, but every asset that we look at is so far gone from the 200-day that it's not even on our charts barely anymore. So those are far, far down. But every one that on here I find important, some slightly more important than other, which, by the way, the flag pattern to me seems like it's exactly the same as the second one on the right side, which is the channel down pattern. The flag pattern, yeah, they're the same, aren't they? The one on the left, second from the bottom on the left, and then second from the top on the right. So again, those are very, very important, but they're not the most important thing to me.
Yeah, and I think, I don't know about you, I had a mouse pad when I first started looking at these things with all these different chart patterns on it.
Yeah, I've had a chart on the wall. There's no question about it. Yeah.
Yeah, and it's one of those things, it's whenever, you're looking at a chart or analyzing a chart, a lot of the times it's just, what am I looking at here? The market might be going up, it might be going down, but, understanding just some basics will help get you started, And the next slide here was just a couple basic things that, I think can add some value, as you're kind of getting started with technical analysis, things that can try and help, because what we're doing with technical analysis is we're trying to find entry and exit points, risk management points based off support and resistance, and being able to try and identify support and resistance. So some of the 4 main ones, that I think, if you're new to this, it's something that you can go out and do. Moving averages, relative strength, Fibonacci retracements, and then your basic trend line analysis. So moving averages. So smoothing price data to help identify a trend direction. So we have simple moving average, as you mentioned, and then the exponential as well, which is something that you look at more closely.
Mm-hmm. Right, and I find those, because again, something you said, if you've been looking at these for a long time, your eyes will tell you kind of 2/3 of the story, but the actual moving averages, when you can see them on the chart, they kind of fill in, the mathematically fill in what you're not registering in your head. So that I think that they're extremely valuable, and I've over the last 2 years I've taken more to trading on 8 and 21 exponential moving averages, pretty much more than anything else. And you have the Fibonacci retracements, and we have at Unfiltered Investor, we do 12.5 harmonics, which are very similar to Fibonacci. Some of the levels come out the same. So let's just, for intensive purposes, say there's the same thing. But the Fibonacci retracements and extensions are really good ways to say where action points are. Like you get in or get in or get short at a certain price, and then you have to look of the next level where you are going to do something, whether it be cover half your position, cover all your position, move your stop up, but they're action points. And I will say this, before anyone buys or sells anything, it would be my advice to have a specific take profit, a specific stop level as you are putting on the trade, and not just kind of eyeball it later, and then try to stick with that, because everybody knows how emotion affects the way you make decisions when you're making or losing money. Like you're making money, all of a sudden, like I'm taking that take profit out, this thing is going forever, and then all of a sudden, boom, it goes to where your take profit would have been and falls off a cliff, and you're like, missed that one. But I would suggest people have a blueprint going in.
100%, yeah. And that was really good. And we're gonna, after I get through this slide, we're gonna get through, I have a couple charts that we're gonna see. I have some of your moving averages, but we'll get to all that, and it's gonna look really nice. But just to kind of get through some of the definitions of what these are before we look at them. So we hit moving averages, relative strength. Basically what relative strength is it's showing momentum. So basically it's on a scale. So if you add a relative strength indicator onto a chart per se, it'll be within, the range is within 70 at the top end and then 30 at the bottom end. Technically speaking, when you're looking at that, if the relative strength is reading above 70, that market is technically overbought. And if it's under 30, it means it's technically oversold. So it can show you, relative to the actual price of the market, is this market on the momentum side overbought, overextended potentially, or, has it just been selling and selling and selling? And it can be used as a momentum indicator, and it's very common that you see, for a lot of different people looking at, markets that have a lot of volatility.
Right. And I use relative strength index in my head looking at charts, but I have never been that adhered to it that much, and not because of any reason, just because I found other things that I like that I'm using on and that I've been successful with. But I'm sure it's a very, very important thing too. It's just not something that's in my repertoire.
Yeah, no, 100%. And then you mentioned, you use something very similar to Fibonacci retracements.
Right. Yeah.
Very, very, very common. I mean, this might be, across the board, one of the most used that we see. Technical analysis tool used by traders to identify potential support and resistance levels. Right. And we'll get into how that looks on a chart and kind of break it down. And then there's just basic trend line analysis, which we'll show you as well. That's basically looking for key points. If a market has been downtrending, what are the key overhead points that the market stuck to, the key points underneath the market that it's stuck to. A lot of that comes down to a lot of, your trend analysis, some of those triangles we talked about. But the next slide here, Jim, this is your bread and butter. This is going to be, I have the 50-day simple moving average, the 21-day exponential moving average, and the 8-day exponential moving average. This was from a while back, and this was just a micro Bitcoin contract, a 5-minute chart. But I wanted you to kind of just tell me what you see when you're looking at this. Kind of walk through, if you were looking at this chart, what would you be seeing?
Well, there was a moment where I couldn't read what the actual asset was, and then I was about to make it bigger and thought I don't need to read what the actual asset is. But that's what we're talking about, is technical analysis. Doesn't matter if it's widgets or whatever it is. Okay, so what I see here is conflicting. So we bounced off the 50-day. The 50-day obviously is important, and we could not get through it. So that to me is a little bit of a shot in the arm from the strength side. Now the 8 is crossing the 21 to the downside. That's an indication of weakness. So ultimately, I'm not going to do, gun to my head right here, and you said you have to make a trade, I would take a small long trade because it respected the 50-day moving average and stop myself out below it. That would be a low conviction trade, and it's not a type of trade I would do because the 8 is crossing the 21 above that. What I'd ultimately like to see is both those moving averages come below the 50, and obviously that's not going to happen for quite some time on the daily because it's, it has to be a couple days before we head lower like that. But ultimately, what I'd like to see is the 8 and 21 both go to below the 50, all of them having some level of downward slope, and the 8 starting to distance itself from the 21. Then I start looking for short positions.
Awesome, yeah. And this is one of those, you pull up a chart, for a lot of people, it can be super helpful. Just, even if you just pick one, even if you just are looking at maybe the 50 and the 200 day, get a little bit shorter and a little bit longer term, where is the market relative to its average over the last 50 days or the last 200 or the 100?
And oftentimes you'll look at a chart, actually more often than not, the most important thing to identify for me a good trader is to be able to look at a chart and say, nope, there's no trade there. To be able to look at 10 charts and say there's no trade there. But finally the 11th or 12th saying, okay, that's something that's shaping up and that might be an interesting opportunity. But there are plenty, and again, when this is one of the most important things of trading, when you start to get bored, you start to see patterns that aren't really exist. You kind of, if you tilt your head and squint your eye, that looks like this, and then you make a trade, and you know you shouldn't have. You just wanted some action, and that's an emotion we have to fight.
Yeah, it's so common. You know, you learn about, someone learns about one new thing, and all of a sudden they're seeing it in every chart, and they got the drawing tools.
Like expression with doctors, when all you have is a hammer, everything looks like a nail. So an orthopedic guy, when all they have is a scalpel, every knee they look at needs surgery. Yeah,
of course. Yeah, it's a great way to put it. But yeah, I mean, as you know, we think about that, thinking about what relative strength is going to be the next one. And just to kind of show you, I wanted to have a visual up on this chart so that it was, a good visual to see it, because we talked about that 70-30 range. So on the next slide, you'll see kind of what that looks like. So if you're looking at this chart, and there's some key points I want to point out just to kind of emphasize what we're talking about. So as you can see, RSI, so we have it down below, relative strength index. You can see the top end of that range is right at 70 and the bottom is 30. A lot of the times you're going to see this market bouncing around within that range. But there's some key points I want to point out. That first big green bar, as you can see, that first big green bar, you saw relative strength shoot up to about 85, which would make this market a technically overbought market, meaning that there was a ton of momentum to the upside. And as you can see, it sharply dropped, and we did see a drop in the price immediately following it. So things like that are, showing just short-term momentum and how these markets can go. And you can see that throughout. Whenever we have these big spikes, you're seeing that market kind of drive up. So it just shows you, because sometimes the market will go higher, but the relative strength is still very neutral. And it doesn't mean that this market is overdone or, oversold, whatever it might be. And if you look at like today, for example, this is why relative strength is important to understand, that it doesn't mean the market's going to come down if it's overbought. And it doesn't mean the market's going to go up if it's oversold. I ask everybody in here, go pull up a gold daily chart and go look at the relative strength. Basically 70 has been almost like a support level in relative strength.
It's been overbought for years, right?
It's been overbought this whole year, basically. And so, it's not something you want to go in and say, oh, this market's overbought, and I'm going to go in and sell it. But it shows you there is great momentum in this market, or there's lack thereof momentum in this market. And it can give you just another indication on, if you're thinking about trading a market, it'll help you understand, where the momentum is, maybe where the mindset of a lot of traders are at.
Yeah, that's, again, like I said before, I don't use a lot of relative strength, but I will add something too. There looks like a trade maybe on this chart based on a very, very simple trend line. The 2 days before that big green candle, the first big green candle, like you said, if you connect the trend line from the low of that to the low, I can't even see the dates on this, but I think you guys know what I mean, to the low from about a quarter of the chart ago till the low near today or yesterday. Now I think some strength above that candle, the last candle from here, indicates a little bit higher. And again, this is Ether now, this is not Bitcoin.
Yeah, this is Ethereum, 5-minute chart.
So to me, just looking at this, again, there's a bunch of things that I would put into this, and many of them I rate on the hierarchy of importance for me higher than this. But I look at that and say, okay, a little bit more strength, and it looks like maybe a bounce, and we challenge those highs again.
100%. Yeah, so I think it's just a good visual. Again, this is something that you open up a chart, you click indicator, you type RSI, bang, it's in there. It gives you a nice little overview. The next one is, Fibonacci retracements. So this one, as you can kind of see, I'll walk through how I set this up, but a lot of the times when you're opening up a chart, for a specific period of time, this is again an Ethereum 5-minute chart, but you're going to want to look for a top and a bottom of a specific point in the market that you want to track. For this chart, I made it nice and easy. I took the very top of the wick from the highest point in this chart, and then you click and then drag the bars all the way down to the lowest point on this view. Basically, from there, it'll show you, all these different points. And if you look at it over a chart, a lot of the times you will see that there is, a lot of resistance or a lot of support at specific levels. One, for example, as this market started to kind of move to the upside, you know, the beginning of it up until about a third of the way there, it's kind of just chopping. And then the market gains some momentum and it shoots higher, gets up to that green line, that 50% retracement. We see a lot of chop in that area. And looking back, you can kind of tell that there is a lot of support and resistance here. You know, anytime we came down and tested that 382 retracement, the market respected that level very, very well. And anytime, you know, we did shoot out above it slightly, but right when we shot slightly out above that 50% retracement, that market did end up selling off for, you know, a bunch of bars right there. And you can kind of see if you start putting, you know, from point A to point B, these different Fibonacci retracements, and then you can extend it out, you can see where points have had common support and resistance points in the past. And, you know, past performance doesn't indicate future results, but it can give you a reference point of, hey, when this market was trading at this level, there was a lot of support here. So, you know, you saw this market come back down and trade at a, you know, significant level. At the very least, you can know, hey, this at one point was a significant level to look at.
Yep. And that doesn't mean that it still is, but it suggests that it still is. There's a lot of things with technical analysis. It's just about slanting probabilities. There is nothing absolute, and it doesn't work in the traditional sense. It just provides a guide. Like I look at this now, remember we talked about I talked about that trend line and any strength above the previous to the current candle, I would buy strength above that. Now I look at this and say, okay, if we turn tail and settle it below yesterday or whatever the period is candle from before, and then below that green candle that's about, I don't know, 8 candles ago, if we settle it below there and then any strength subsequent to that, I think it goes back to that 50 Fibonacci. And again, I mentioned the 12.5 harmonics, which 50 lines up exactly with ours. Ours would be 12.5, 25, 37.5, and 50. And we think they work slightly better, which we think these work fine too, and more people use these. But that 50 was a level of importance. So odds are it is still going to be a level of importance. So I think then it trades down there. Then that becomes an action point, whether it be cover half of it, cover all of it, or just reduce my buy stop, my protection, or bring that down closer to the market to lock in profits. But I really think that's an interesting way to look at the Fibonacci's right there.
100%. And you brought up a good point too. Like you know, as you kind of learn about these things more, you know, there's a lot of customization on all these platforms here. You know, with IB, there's a lot of different things that you can do in order to customize what levels you want to look at.
Right.
So,
and by the way, I use Interactive Brokers, and it's a very good system. And I say that because I definitely think they should sponsor my podcast at some point in time. But anyway, go on.
I love it. No, I love it.
I love your platform, Interactive Brokers.
Yes. Yeah, no, it's very, very good. The last one is it's as basic as it gets. You know, when I first started looking at charts, it was try to figure out, you know, is this thing going up? Is this thing going down? And find common areas of support. And, you know, this is basically up to your own intuition, up to your own eyeballs. But, you know, right here, like this is a December gold chart that I had from a while back. Prices are significantly different now, but this is an hourly chart. So we were looking at 5-minute charts. You know, if you want to take a step back, you know, there's even, you know, you can look at dailies, weeklies, monthlies, and do a lot longer term. But thinking about an hourly chart for gold here, when I opened up this chart, there was 2 things that stood out to me immediately. One, this thing's moving up to the right, and 2, there is a respected level as it's going to the upside. You know, there's not, you know, there is points where the market is selling, and you're seeing, you know, multiple, you know, hour bars in a row where the market's selling, but it's holding this pattern. So this blue line on the bottom is showing just the ascension of the market, and anytime we went down there during this period, the market respected that level and then came higher. And for this, we were hitting new high, new high, new high. And, you know, at the time it was new all-time high, new all-time high, and it just kept going. And then I looked at the top of it. Okay, we hit an all-time high price. The market then, you know, started selling off, and we weren't able to achieve an all-time high. And this is one of those triangles that we're talking about that you can start to identify. As these markets, you know, as that consolidation gets tighter and tighter and tighter, what oftentimes you'll see is a strong move either to the upside or to the downside. So whenever these markets have that sharp consolidation in, you know, a smaller triangle pattern, you'll see, you know, typically either the breakout where the market's going to go up and retest that all-time high and potentially go higher, or you're going to see that market break below that longer term trend line and that could, change things to the downside and could have a more aggressive up or down move from there.
Yeah. So what you said, that this was very, very basic, and it is very, very basic, but it also works quite often. This is a pattern. This is a tradable pattern to me. So if you ask me how I would trade it, here's what I would need to see. And what bars, what duration bars are we seeing there? Just so I refer.
These are 60-minute bars.
So 60-minute bar. So I'd like to see a 60-minute bar settle above the trend line and also above the wick from 2 bars ago, which is hit the trend line there. So a settlement above there. Do I trade it? No, but it's getting close. If then in the next 60-minute bar trades above the high of the previous 60-minute bar, to me that means there's a trade there, and I would probably go long it. Which, by the way, it's 36 and change in gold. Since we know it happens, I'll buy all of the gold, because where's it going? 4,500, right? Yes.
Yes. Yeah. No, I like that you said that. Yeah. I mean, sometimes things that are as basic as they get, they're as basic as they get because there's something to it. It's kind of the starting point for a lot of technicians out there. It's, hey, figure out your trend lines, figure out how you like to try and analyze things. So
right. And that's a very basic one, and it works.
100%, 100%. So, as we kind of wrap things up here, I'm glad we were able to go through some of those real examples, but, the last slide I have is kind of just, putting it all together. So identifying opportunities is what we were talking about today. So if I had to give you the, 2-minute spiel of this whole presentation, step 1, trend identification. Using moving averages, trend lines to determine overall direction of the market. Thinking about fundamentals as well. What is your fundamental background? What do you think about a market? Do you believe that this market, if it's, thinking about futures contracts, if you think that supply is going to get really, really hurt overall for crude oil, or if you think there's going to be big industrial demand for silver, what does that do for you? Step 2 is confirmation. Look for a signal from an indicator such as RSI, such as moving averages, anything that you're looking at, your confirmation signal that, okay, it's time for me to really take a look at this market. Step 3 is going to be execution. So identify a strong chart pattern like we mentioned, figure out your entry and exit points, and then manage it. Always using stop losses for your orders, always knowing, hey, what's the worst case scenario on this trade? That's more important to know than best case scenario. Worst case scenario is, I hit my stop loss or I get stopped out of this market. Hopefully that's exactly what it is, and you've managed that risk properly. Understanding, hey, if this market rips higher right after I buy it, am I going to take every contract off at my level, or am I going to take 1? Am I going to take 2? Am I going to cut half, a third? What does that mean for you? So basically it is figure out your fundamentals for a market, take a look at the charts, figure out good entry and exit points, and manage that risk. That's kind of, when I'm telling people the short pitch, that's what I recommend. Jim, I'd love to hear your thoughts on that.
So the managing risk part of it, I think, is absolutely paramount. We have a saying is that there are old traders and there are bold traders, but there are very few old, bold traders, which means that if you are somebody who just is damn the torpedoes, full speed ahead, the history shows that you don't last that long in this business. If you are someone who's very, very cognizant of managing your risk, and again, the options are a way to do that as well as stop losses, and that's what I often employ for my risk management tools too. But then if you, again, you're trying to take advantage of price anomalies, every trade isn't going to be the retirement trade. You just have to, identify opportunities, try to hit singles, and manage risk. I think it's incredibly important.
Fantastic. Well, hey, Jim, I really appreciate you coming on. I think, part 1 and part 2 have been awesome. We're going to segue next week. We're going to get a little bit more in depth. I believe we're going to be talking about different options and things like that. But yeah, this is 2 out of 5. So we'll have 2 more that we're going to run through in November, and then we're going to have one early December that's going to wrap us up for the year. Again, Jeff, thank you. Thank IB for having us on. I really enjoy, talking with Jim here about all these different things. If there's any questions in the chat, we'd be happy to answer them with a few minutes left here. But yeah, again, thanks everybody for joining. I think it was a really great session.
Yeah, Jim and Ryan, thank you guys for putting this on. This was great. There is a question. I think we have a few minutes left that we can hit. So they're asking, AI trading systems today use everything from order flow analytics to machine learning price predictors. In that environment, how relevant do you guys think that these classic chart patterns, triangles, wedges, head and shoulders, compare with the multi-signal approach that these I guess these AI trading systems are using?
I think that's a great question, and my initial answer is going to be I have no idea. However, I will add to that because we know this, that I've been trading these stuff on using technical patterns for 38 years, and none of them continue to work forever. So a pattern becomes interesting, and then maybe becomes in vogue, and everyone starts looking at it, and then it becomes less and less efficacious. So you look for something else. So I have a feeling that AI is going to change it. And if I start seeing my technical patterns begin to not work as well, then I will look for ones that do. But other than that, I can give no guidance on that. AI is changing things in so many different ways, not just in trading, but in the rest of this world we live in, that to see where everything falls out, I think is very, very difficult. Do you think that's a cop-out answer, boys, or no?
No, I think it's a fair answer. I think it's a very fair answer. I mean, I think, I think it makes total sense. And like you said, I think that's, again, without giving advice, I think you mentioned bold and old traders, right? So like the old traders seem to be the ones who can adapt and
adaptation. That's the key. Yes.
Yeah. I mean, my thought right away, I mean, thinking about that, the answer being, I don't know, I mean, go back to, 2005, tell somebody from 2005 they're going to have the power of a ship that can go to the moon in their pocket that they're going to use every single day. No one would believe you, and no one would even understand that concept. So who knows where this thing will go?
Who knows? Exactly. We just know what's today.
Yep, exactly.
All right, I think that's all we got for today, guys. So thanks again. Looking forward to part 3. And I know, Jim, you'll be cheering on your boys against Rutgers this Saturday.
Sure will. My chief in the back, my eye in the back.
Love it.
Yeah.
All right, guys. Well, enjoy the rest of the week. And thanks again.
Thank you. Have a good one.